Welcome to #Real Estate. Previously on the show, we explored offshore property investing as a way of diversifying your portfolio. This week, we take a look at tax and the costs involved when acquiring a property. Stay tuned.
Hello and welcome to another exciting episode of #Real Estate. I'm Debohoma Fodi of TM Group.
And my name is Samay Zaki. Now, South Africa has a well-developed and regulated taxation regime. While the laws are constantly being revised and amended to keep them up to date and in line with international best practice, it is important for investors to understand this in order to make informed decisions regarding property.
Don't move as we take a quick look at some of the tax laws, regulations, and implications when investing in real estate.
Many South Africans have turned to property as an investment class and entered the property market as investors. But like any other investment, you need to understand how the investment works before deciding to invest your hard-earned money. One of the most crucial aspects of intelligent investing is a thorough understanding of tax implications of your investment choices. Having the right ownership structure will help ensure you protect your investment while saving on tax at the same time.
It's a good starting point in terms of looking at how we own property as an investment. We can really quite quickly jump into the different options, and those could be either owning it in a legal entity or in my own name. And within those two areas, I can actually then obviously expand it further, whether the type of entity is a trust or it's a closed corporation which has been phased out, or if there's any other sort of entity. But I do believe that the ownership structure is not necessarily the right starting point. I think the point is often going back to the conversation around how are you going to be managing, or how are you going to be realizing this investment as an investment, or is it going to be seen as a business? Why that's important is a passive investment would be one where you are not actively involved in managing that asset and you are just realizing the benefits of that return. And that would be like a listed share in a property portfolio, and that would be passive. And when you're considering the ownership structure of a passive investment, it's a very different decision as to whether you are being actively managing a physical asset. So a passive investment could be owned in your own name, or can be owned in a trust or in a company. And there's certain criteria that you would go through as an investor making that decision of how I own that investment in a listed security of property. But if we're talking around a physical building, a bricks and mortar, then the ownership structure is quite important in terms of actually understanding that you are running a business. And when you're running a business of property, you then need to go into careful consideration as how you separate yourself as the investor from the actual risk of running a business, the credit risk. And that's where using a legal structure like a company is often your best starting point. So a company would protect you from creditors in the event of business failure. And that's where that decision around the ownership structure is vitally important, is how do you separate your individual persona from the actual business asset that you're running. I think what's relevant to delve into would be looking at the considerations around ownership structure of multiple properties. And often what is the starting point or is the default position is where you'd set up one property company, and that property company would own all your property investments. So it would buy office block A, B, C, and D, and would own all 4 buildings in one company. And that's okay, and that's very feasible, and it's effective, and it's an efficient way of running your property business. However, one should pause and consider sort of the long-term consequences of that structure. And by that, what I mean, the consequence would be once you've grouped all your property assets into one legal entity, moving one property out or selling it from the portfolio will have knock-on effects, not only in terms of capital gains tax, but also in terms of the ownership structure that you are limiting yourself to. So if we have a scenario where you have property company A and it has all its physical buildings in one company, you are restricted to the ownership structure being the same shareholders that would own all those 4 buildings. Right. So you would have one shareholding structure that owns that legal entity. An option could be to actually have each office building or each physical building owned by a separate company with a holding company that would then in turn manage the ownership of those property companies. And so the effect is the outcome is still the same, where you have a holding company structure, or you have a group, a portfolio of properties under one property group. However, you've got a lot more flexibility around differentiated shareholding at each of the company levels. And that becomes a lot more flexible, where you can now have different shareholders, be it empowering, having an empowerment strategy on this office block in property company A, and you could have BE shareholders as opposed to actually then in property company B, you could have 100% owned by your family, which may be a different shareholding structure. And property company C may have a trust as the shareholder, or it may have different third parties to it. So the flexibility that's gained by having a group structure can be quite advantageous.
Stay with us. After the break, we're catching up with property experts Richard Hardy and Mikhail Moyo.